Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Atikah binti Mustafa Kamal, and today I will be presenting the factor of falling ringgit Malaysia. Okay, so the first one is rising interest rate. Malaysian ringgit has experienced a decline against US dollar due to the rising interest rate. This has affected businesses' financial structure and the ability to finance debt. Rising interest rate can significantly impact business costs, making it crucial for businesses to stay ahead of competition and adapt their plans effectively. High interest rate in developed countries may reduce debt repayment for developing companies. Companies may lose too much funds due to settling the debt at high interest, potentially reducing their growth, and companies may also consider reducing their expenses such as staff reduction or maybe employee salaries to cut fixed costs. The next factor is imbalanced trade of goods. Malaysia trade performance is expected to fall due to the slowdown in export, causing a decrease in ringgit value. Imbalanced trade, including import and export goods, has improved, with export rising by 2.8% to RM354.6 billion and imports expanding by 3.7%. This improvement is attributed to a lower total export of goods, but the percentage of import goods expanding above the export goods, which is potentially growth a negative GDP rate. Imported goods from other countries can benefit consumers, but should be set a limit or quota to prevent excessive import. And the last factor is COVID-19 global recession. COVID-19 pandemic has led to a global recession, and Malaysia has experienced severe supply disruption with job losses. The pandemic has reduced the ability of people to work, leading to a decline demand in services like hospitality. Social distancing measures of fear infection also reduced the demand. Income from job losses and uncertainty about the future has led to household and firms to delay their spending until the economy recovers. This has led to a decrease in demand for goods, affecting cash flow and causing businesses to face bankruptcy as they cannot afford to generate profit from sales.
Assalamualaikum, my name is Nur Sofia, and today I will be explaining about how the fall of Ringgit Malaysia has impacted its economy. Now, without wasting any time, the first point is that it has influenced the country's trade balance. The depreciation of the Ringgit Malaysia has made exports become more competitive, leading to an increase in export volumes. However, it has also counterbalanced by the higher import costs, which is impacting the overall trade balance. Moving on to the second point, which is it has implicated the inflations. The depreciation of currency has increased the cost of imported goods, which contributed to the inflationary pressures, making it more challenging for consumers to maintain purchasing power. Now, thirdly, the fall of Ringgit Malaysia has influenced foreign direct investments. While the depreciation of the currency may make Malaysia seems like an attractive destination for foreign investors due to the lower investment costs, it can also increase the investors' uncertainties as they assess the risks and returns associated with investing in our country, Malaysia. Last but not least, the fall of Ringgit Malaysia has affected tourism sector as a tourism and services sector. As the depreciation of the Ringgit Malaysia may make travelling to Malaysia more expensive for foreign tourists, which has impacted the sector's growth. That's all from me. Thank you.
Considered one of East Asia's miracle economies before the crisis hit because of its consistently strong growth rates, which is an annual average of 8.9%, and low inflation rate, which is an annual average of around 3 to 4%. The country's concentration on industry, particularly electronics, guarantees strong employment rates. More foreign tourists started visiting Malaysia after July 1997. The Malaysian The Malaysian financial sector has maintained its overall confidence and stability throughout the global financial crisis, thanks to its robustness and negligible exposure to subprime related assets and afflicted counterparties. Ample liquidity in the financial system also mitigated the risk of systematic contagion, thereby enabling the financial sector to continue providing financial intermediation and services to the broader economy. Following the Asian financial crisis, successful reforms of the financial sector have strengthened the solid fundamentals underlying Malaysia's robust financial sector. At the onset of the crisis, Malaysia's banking system's capitalisation level was at its highest level in history. The Malaysian banking system's risk-weighted capital ratio, which is RWCR, and the core capital ratio, which is CCR, remain above 12.5% and 9.9%, respectively, from 2007 to September 2009. Overall profitability as measured by the return on assets and return on equity was maintained at 1.6% and 20.8%, respectively, during the period of 2007 until 2008, and then moderated to 1.3% and 13% respectively from January to September 2009, while remaining in positive territory as business conditions slowed significantly in tandem with the general contraction of the financial economy.
A weaker currency can raise import costs by making it more expensive to acquire goods and services from other countries. When enterprise pass on greater cost to customer, this can contribute to inflationary pressures. Higher inflation reduces consumer purchasing power and can harm economic growth. Furthermore, a declining currency may raise the cost of company financing. If a considerable portion of their debt is denominated in foreign currency, the repayment burden increases as the value of the local currency falls. So this might have a negative impact on the company's profitability and financial stability. A weaker ringgit make Malaysian asset less desirable to foreign investors. When a currency value declines, investors may expect smaller gains when converting their investment back into their own currency. This may inhibit foreign direct investment, which is FDI, and restrict economic progress. So, reduced FDI can harm the manufacturing, infrastructure development, and technology transfer industry. A weaker currency can boost export by making Malaysian goods and services more competitive in overseas market. It does, however, boost the cost of import, worsening the trade deficits. So if the value of the currency declines dramatically, it may have a negative impact on the country's trade balance and increase reliance on imports. Currency depreciation can also cause stock market volatility, especially for companies that have considerable foreign exchange exposures. So companies with a high import expenditure or significant foreign currency debt may see a reduction in profitability, leading the stock price to plummet. So investors may also become more skeptical about the overall economic outlook, causing stock market indices to fluctuate. So a weaker currency, on the other hand, may make Malaysia appealing to foreign tourists. Accommodation, dining, and other services may become more inexpensive, increasing tourist income, and this has the potential to promote certain economic sectors such as hospitality and retail. But not least, a falling currency may reduce the value of remittances sent by the Malaysian employee working abroad. So when the value of the Malaysian ringgit declines, the amount received by Malaysia families and individuals lower, diminishing their purchasing power and potentially cutting domestic consumptions.
To recover from the fall of ringgit value, it would take a longer period of years. There are no ways to prevent the declining of ringgit Malaysia from happening, as most of the factor is out of control, such as involving foreign country which is US. Next, the recession that occurred caused by COVID-19 is unexpected global phenomenon that has affected our country, but there are few ways for financially prepared of the recession period. The first way is to build an emergency fund. An emergency fund is money set aside to cover unexpected expenses. It helps you to survive in a few months and can be withdrawn immediately in case of bad occurrence. Emergency funds are crucial during COVID-19 pandemic as they help to cover our daily expenses up for 3 to 6 months until the economy improves. This helps to manage your financial problems even if the funds actually are not enough to cover them. Second recommendation is to manage your money wisely. Proper money management is essential for achieving financial stability and security. It reduces stress and anxiety, helps achieve goals faster, and allows great individual wealth growth through wise investment and consistent saving. Good money management habits also ensure proper handling of unexpected diseases like COVID-19. By creating a budget that aligns with your goals, you can make informed financial decisions and achieve your goal more efficiently.
In conclusion, the Malaysian financial system has been resilient despite the global economic recession, with the banking system capitalization level at its highest level in history. Changes in trade dynamics can have an impact on industries that rely on international commerce, such as exporters and those that rely on imported raw materials. A lower currency can enhance exports by increasing the competitiveness of Malaysian goods and services in international markets, but it raises the cost of imports, widening the trade imbalance. Currency depreciation can also generate stock market volatility, particularly for corporations with significant foreign exchange exposure. A weaker currency may make Malaysia more appealing to overseas tourists, boosting specific economic sectors such as hospitality and retail. The real impact of a currency depreciation is determined by various factors, including the degree and duration of the devaluation, overall economic circumstances, and the government's response to stabilize the currency. Political instability and concerns about China might undermine investor confidence, resulting in capital outflows and a decrease in foreign direct investment. This could have a detrimental impact on the global financial market and enterprises' capacity to raise financing for expansion or investment.